everyone, to another episode of Insightful Principles. In today's content, I want to talk about, does the expansion of the money supply lead to inflation? Many people that have talked about this concept look at inflation from two different aspects, where inflation is simply a price increase among goods and services. I've heard Michael Saylor say in some of his interviews that inflation is a result of asset prices increasing over time as well as goods and services. And then some people will also say that inflation is a direct correlation to the expansion of the money supply. So I want to break down all of those concepts into this episode. And I've talked about with some of my previous content more recently about fractional reserve banking and how the Federal Reserve plays a vital role with reserve ratios, which can impact the amount of liquidity that's actually put into the market. And I've talked a lot about how with underfunded pensions, how the U.S. is in a lot of debt. They may default on a lot of these promises or other things such as Medicare, Medicaid, and even Social Security. So I'm going to continue to keep building on top of these topics because I think it's vitally important to understand from a macroeconomic standpoint how our economy works. So we see more recently with the CPI report last week, year over year, prices have increased 8.2% when we look at over the last year with a lot of goods. When we think about food, housing, energy, gasoline prices, the whole nine. And it really made me think about, okay, what is the relationship between the expansion of the money supply and inflation? And does that have a direct correlation? And I think the very first thing that you also have to think about is when we look at our money supply, it's simply the amount of money that's in circulation. So think about notes, think about deposits, and also coins. This is what the money supply is. And when central banks tend to expand their balance sheets, or they're looking at ways to stimulate the economy by creating more quantitative easing, this will also create more consumer spending and also more demand throughout the economy. And essentially, the Federal Reserve is injecting liquidity in the market to improve economic activity. Now, Milton Friedman, he's an American economist. He once said that inflation is caused by too much money chasing after too few goods. What he means by this is that if the money supply grows at a higher rate in comparison to the economic output, which is simply the growth in the economy, this can lead to inflation because the money supply is growing too rapidly, but growth is not keeping up with the money supply. And oftentimes when the money supply and also the economic growth output is the same, you tend to not see any changes with inflation, whereas you'll see more of a deflationary environment where prices tend to stay leveled or they go down. So that's just kind of, an example of what Milton Friedman is talking about. And they also may have a demand for more goods and services. And when there is a higher demand, firms tend to have to raise prices, whereas when demand is low, that means that firms will often lower their prices to attract more demand. So this is a situation where you actually see inflation really being impacted by the money supply. And some real world examples of the expansion of the money supply affecting inflation was how Germany was affected by hyperinflation in 1923. And this was the result of the First World War that led Germany having to pay very high reparation payments, and they weren't able to make those reparation payments, so they had to continue to print money to be able to help firms be able to pay their workers. And this really just created a situation where inflation within their economy ran rapid and the government wasn't able to get control on bringing inflation down. And this literally led inflation in Germany to be somewhere at 20,000% monthly. So their inflation rate had really skyrocketed due to the expansion of the money supply. And I also want to show you this graph here that really shows more recently, when we think about the US in 2020, what happened with the expansion of the money supply. Now you can see here in 2009, when we did have quantitative easing, when the government was actually trying to respond, well, the Federal Reserve was looking to respond to the Great Recession. When they printed the amount of money more frequently, it didn't lead to inflation. And some of the reasons why an increase in the money supply doesn't lead to an increase in inflation is because with the scenario that we had back in 2009, banks had more excess reserves, and this allowed them to be able to have higher reserve ratios. And kind of what I've talked about with fractional reserve banking, with reserve ratios, that's simply the amount of money that the bank has to hold as reserves within their bank. So at this time, you had a lot of banks that had higher reserves. They weren't looking to lend out much credit into the economy. So this extra money supply that was injected into the economy, it wasn't able to reach into more of the general public because banks weren't lending out as much when we were responding after the Great Recession. We had the housing mortgage crisis, so a lot of banks were hesitant to being able to lend out any type of credit to a lot of the public. So inflation really wasn't impacted during this time. When you think about from 2009 all the way up to 2020, but the situation of what happened in 2020 is our Federal Reserve printed trillions of dollars in response to the pandemic that we have, and we had a very strong recovery where we seen asset prices went up among stocks, cryptocurrency. You look at the bond market, you look at real estate. We were really in an inflated bubble, and when we had a lot of those stimulus checks that were sent out from 2020 throughout 2021, this caused more consumer spending throughout the economy. And then when we think about when we had the Russian-Ukraine crisis that happened in spring of 2022, that really led to the rise of oil prices. And we also seen a lot of different supply chain constraints that have happened globally in a lot of areas when you think about Europe, China, and it's been a lot of different issues when you think about the expansion of the money supply has caused a lot of the inflation that we're seeing now. So when you are trying to get a better understanding of if the expansion of the money supply impacts inflation, the very first thing that you have to consider is, does the expansion of the money supply increase much more rapidly than the economic output? Usually when that is the case, it is going to lead to inflation because you have a lot more money printing, but then the economic growth of the economy is not keeping up the pace with the money supply. Whereas an example that I explained with more in 2009, that shows that there was more excess reserves with banks and they weren't lending out as much to the economy. So a lot of the funds that they had in the bank wasn't able to be dispersed in a wider economy, which didn't really affect inflation. But now it's a much more different scenario because we have a lot of other issues happening globally that has played a role with the rapid inflation that we also are seeing here in the US. So I thank you all so much for listening to this video, watching this video. If you could please do me a favor, if you can like, subscribe, share this video. Don't forget to hit that notification bell below so you can be notified every week when I drop content. And thank you for watching and have a blessed day.